On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. Morning team, hope you're all well. Let's talk about everything that happened across financial markets last week, then let's turn our attention to what's coming up in the days ahead. Starting with global share markets, it was a rough week for some markets. The S&P 500 in the US was down 1.5%. That was its seventh decline of the last 9 weeks. So the S&P 500 index is now 9.2% down from its February peak. And with just one trading day to go, being Monday, it's on track for its worst quarterly decline since September 2022. The March 2025 quarter, so far the S&P 500 is down 5.1%. So we'll see how we go on Monday. A lot of that weakness has been driven by some of those stocks that have been great performers in recent years, such as the Magnificent Seven group of stocks. And we all know the story there. That group performed exceptionally well in 2023 and in 2024. So they have come under a bit of pressure because that's a natural place to take some profits when you look to take a bit of risk off the table. So the Mag 7 is down 18.4% from its high, which came in December. And in comparison, the other 493 stocks in the S&P 500 index in the US, the other 493 have fallen a more modest 6.7%. So that's something important to bear in mind. The weakness has been centered on some of those parts of the market that have been high flying. European shares also down last week. They were down 1.9%. Japan was 1.7% lower. Emerging market equities slipped 0.9%. In contrast, the FTSE 100 in the UK up just a smidgen, while Australian shares were up 0.6% and the NZX 50 here in New Zealand rose 1.4%. Interest rates, little moved. The 10-year Treasury yield in the US finished the week at 4.2%, and the New Zealand 5-year swap rate finished the week at 3.7%, barely changed from where it was a week earlier. So US Treasury bonds and New Zealand corporate bonds held their own last week, even though many share markets were a little bit volatile, and those two asset classes have delivered positive returns in 2025. Gold has also proved to be a very useful diversifier. Gold prices are up 17.6% so far in 2025, and they're sitting at fresh record highs. So it's important to note that while we are seeing a lot of scary headlines, not everything is down this year. The US market, yes, it's down a little more than 5%, but European shares are up 7.5%, UK shares are up almost 6%, emerging market shares are up a little more than 4%, New Zealand bonds are up, US Treasury bonds are up, gold is up, so there's definitely been volatility, that's for sure, but not everything is across the board down year to date. So just keep calm, stay in touch with your advisor, and rest assured that if you do have a globally diversified portfolio across a range of asset classes, you're probably actually going okay. You might have seen a bit of weakness, but it might not be quite as bad as you may think. Right, let's talk about some of those key releases last week, and I was watching flash PMIs very closely. These are activity indicators, and they were out last week covering the month of March. Generally solid, improving in all regions with the exception of Japan, so that's good, but still plenty to just keep us on our toes. The US composite PMI rebounded strongly to 53.5. That was well above forecasts. It was the strongest in 3 months. However, business expectations for the year ahead did also fall to the second lowest we've seen since late 2022. So you've got businesses out there that are going okay, but they're definitely getting more cautious about the outlook, as you would when you're just wondering about some of these policy moves and where the goalposts might be. The PMIs for Australia, Europe, and the UK all pointed to expansion. They rose to the highest in at least 6 months, so in some cases a little more. Japan was really the only lowlight. Its PMI slipped from 52 to 48.5. So 50 is your break even. So they went from being above break even to below it. And that was the worst reading we'd seen in more than 3 years. Japan's economy is a very export driven economy, and it could suffer more than most amid some of these US trade policy changes. So that could be what's keeping sentiment low. In the United States, we had another inflation reading, and this wasn't great news. It was a little hotter than expected. We also saw another fall in consumer confidence. So, first, inflation, the Personal Consumption Expenditures Report, the PCE inflation report. This is the one that the Federal Reserve watches very closely. It reflected stronger pricing pressures than people were hoping for. So the headline PCE up 0.3% for the month, and the annual pace of increase unchanged at 2.5%. That was in line with expectations, but the core measure rose a little more than expected. It was up 0.4% in February. Forecasts were only for 0.3%, so not a huge difference, but that's still the highest monthly read that we've seen in 13 months. And at an annual level, the core PCE rose to 2.8%, which was above forecast for 2.7% and actually in line with where it's been for the past 12 months. But I guess markets are very sensitive at the moment because of everything that's going on, so they don't like to see inflation readings that are hotter than expected, in part because it suggests that the Federal Reserve will be less inclined to provide any support in terms of reducing interest rates. So that came out on Friday, that hotter than expected PCE inflation reading, and that was one of the reasons that we had quite a weak day on Wall Street on Friday. At the same time, also on Friday, we got the latest University of Michigan survey, and that saw consumer sentiment for March lower than initial estimates, and long-term inflation expectations rose more than expected. They rose to 4.1%, which is the highest we've seen since 1993. So people are nervous, businesses are nervous, consumers are nervous, and what that means is you're seeing people speculate about lower potential growth and higher potential inflation, which is not a great combination. And a lot of this comes back to some of those tariffs. Tariffs will add to cost pressures. They will make things more expensive. So that means higher inflation. And at the same time, they will take a chunk out of growth, which isn't fantastic. So that's really what's driving markets at the moment. Looking ahead, it will be a really busy week, and the focal point will be absolutely details of these US reciprocal tariffs, which are scheduled to be implemented on Wednesday, April the 2nd in the United States. So that will be Thursday in New Zealand. A day later, we'll see 25% tariffs on all cars imported into the US. That will be on the 3rd, which is Thursday, so that will be Friday in New Zealand. So sort of the second half of this week, it could be quite volatile. Now, we're not sure whether those reciprocal tariffs will be broad on everybody and everything, or whether there will be some carve-outs and they'll be a bit more targeted and a bit more specific. If they're the former, that won't be taken well. If they're targeted, I think markets will like that because it means they won't be on everything and everyone. You will see some method to the madness. But the prospect of adding inflationary pressures and that tariff-induced slowdown is really keeping people nervous. So we're going to have to watch this space. We might have to wait until that day till we find out what things look like, or we might get some news flow out of the White House. It could come anytime, really. So we'll just have to wait and see, but that will absolutely be the focal point for investors, those April 2nd tariffs and then the car tariffs. And the second one is probably less relevant because we know where we stand there. But those reciprocal tariffs, they are causing a lot of uncertainty and a bit of caution out there from investors. In terms of economic releases, it will be a busy week in the US. We will get the latest ISM indices and we will get the jobs report. They're both due out this week. So the ISM indices, Institute of Supply Management indices, will get one for the manufacturing sector and we'll get one for the services sector. The manufacturing one is out on Tuesday, services sector one is out on Thursday. Last month, the ISM manufacturing index was above the break-even level. That was the first time we'd seen 2 consecutive months of expansion since late 2022, so that was good news. And the services ISM strengthened to 53.5 as well, which was quite a bit ahead of forecast. So it hasn't been all bad out there. You're still seeing some good economic prints. Not to say that this one will necessarily be good. We'll have to wait and see. But what we didn't like last month was that the manufacturing prices paid index rose further, and that's an inflation indicator. That was actually the highest that we'd seen since 2022. So again, you've got expectations that tariffs could be pushing up prices. So that'll be in focus on Tuesday, and then on Thursday, overnight in the US, then you'll have the jobs report, which is always a Friday, so that will be Saturday New Zealand time. This will cover March. Markets are expecting 120,000 new jobs to have been added. I think last month it was about 150,000, and the unemployment rate is expected to increase slightly from 4.1 to 4.2. Here in New Zealand, we will get the ANZ Business Outlook survey for March. This will be out at 1 o'clock on Monday. Last month, confidence improved a little bit, rose to 58.4. That's well above the long-term average, and it's not too far off that 10-year high that we saw back in December. The own activity measure was also stable. It's looking good, well above historic levels. So good news on that front, even though we're not seeing any firm evidence of an economic uplift just yet. These surveys do tell us that businesses are quite upbeat about what's coming over the next 3, 6, 9 months. Inflation indicators were stable, although there were still a few signs that we've got cost pressures out there that we can't ignore too. It's not just the US. The net proportion of firms intending to raise their prices over the coming 3 months actually increased to 46.2. That's the highest since April last year, and that measure has lifted for 7 of the past 8 months. So we've got to keep an eye on all these things. That's on Monday. We'll get a dairy price auction on Wednesday morning. Dairy price is obviously going pretty well. You've got a Fonterra payout that's going to be $10 or more. So the dairy sector in good shape, even though you have got drought in places, and we'll be looking for that update on Wednesday morning. Across the Tasman, the Reserve Bank of Australia is holding a meeting on Tuesday at 4:30. Its usual monetary policy decision. Now, back in February, the RBA cut its cash rate for the first time since 2020. It cut it from 4.35% to 4.1%. So it's moved a little bit more slowly than many other central banks. Obviously, our OCR here in New Zealand has been coming down since the middle of last year, and the Federal Reserve in the US, or the Bank of England in the UK, or the European Central Bank in Europe, obviously, they have all been reducing policy rates, and they started last year. But the RBA held the line until February, just last month. So it's been moving a little bit more slowly. It will keep reducing interest rates. The next move will be down, but I don't expect that to come on Tuesday. I think May is much more likely. So we'll be watching the RBA as well. Outside of that, there are a couple of other central bank highlights to keep an eye on, a couple of important speeches. We've got ECB President Christine Lagarde speaking on Tuesday. I think that's at an AI conference that the ECB is hosting in Europe. And then on Friday, this will be important, Federal Reserve Chair Jerome Powell is speaking. So interesting timing there, because we've just had that hotter than expected PCE inflation report. You've got longer term inflation expectations in the US tracking higher. Consumer confidence has fallen quite sharply, and we should know where we stand with some of those tariffs by the time Jay Powell speaks on Friday. So that will be a really interesting one to keep an eye on. Not a lot going on the corporate front, but we're not too far away from that April reporting season. Obviously, Tuesday is April 1st. Maybe these tariffs are an April Fool's joke. Wouldn't that be fantastic? I doubt it though. But it'll only be a couple of weeks into April, then you will start to see those US banks start reporting results for the first quarter of the year. So at least that'll give us something to talk about and speculate on that is not related to tariffs or political issues. It would be great to refocus on what's actually really happening with corporate earnings. But for now, tariffs are the name of the game, and they will be the focal point of the week. So thanks for listening, team. We'll talk again soon. Enjoy your week.
For more insights, visit craigsip.com.